Hello and welcome to Nothing Ventured Live with me, Aarish Shah. Today in the studio, I have the incredible Eghosa Omoigui, founding partner of Echo VC, and Jonathan Sun, founding partner at Horizon VC. Although watch this space, there are some changes coming. This is the first live show we're doing here at Nothing Ventured. So it's going to be a bit of a free-for-all to some extent. We're going to be talking about everything from the debacle at OpenAI to the future of venture to what's happening with SoftBank and Tiger Global as their portfolios come somewhat crashing to the ground, plus much more. We're going to get some hot takes on where we think 2024 is heading and how we're going to close out 2023. But first of all, Eghosa and Jonathan, welcome. Really glad to have you here.
We're excited.
Thanks for having me, man.
Doing it.
Excellent. So let's start with the big news of the week, right? So I think you'd have to have been living under a rock not to have seen what's been happening at OpenAI. We've had a revolving door. At last count, I think Sam Altman was sacked by the board, tried to get back in, had 700 of the 750 odd employees write a letter asking him to come back, or telling the board that they would resign if he didn't come back. He then joined Microsoft, and then I think a day later ended up back at OpenAI, and half the board was removed. So my first question to both of you is, what happened here at Wrong Answers Only?
You want to go for it?
He spent a lot of money that he shouldn't have.
Okay, I mean, like, they definitely burned through a lot of cash, I'm guessing. Eghosa, what do you think?
Oh, I don't know whether this is the right answer, because I don't know if we actually know what the right or wrong answer is. But when it first started, I think, so I've known Sam for a long time.
Got it.
Right, and knew him from back in the days when he was doing Looped.
Yeah.
And so and competed against them, and he's a remarkable founder, and unbelievably ambitious.
Yeah.
I mean, and I think what happens is that when you have unfettered ambition like that in the context of a non-profit set of guardrails, you're going to have problems. And they're very foreseeable and very predictable, and that's, I think, is where we ended up.
Yeah.
So do we think, as an example, and yeah, this is maybe now getting into the right answer rather than the wrong answer, right? But
Yep.
A lot of this was down to the board, the corporate structure, right? So you had a non-profit that owned the essentially OpenAI, and the board of the non-profit has had slightly different purpose, I guess, to the board of a traditional corporation, right? In the sense that traditional corporation, you've got to act in the best interests of all stakeholders, shareholders, etc. Whereas the board of the non-profit, I think it was like, do no harm kind of ethos, right? So a lot of the kind of hot takes out there on the internet are that, there was some model that was just out there that was gonna, completely had no guardrails, was doing an amazing amount of stuff, but was just not ready to be put out into the public domain. And that was maybe one of the reasons. Obviously, the main reason I think the board gave was they didn't find Sam to have been, transparent in his communications. They couldn't trust him, I think was the words that they used. But it feels to me like, whatever happened on the surface, there's a hell of a lot going on behind that, right?
Yeah. And it's interesting you bring that up, because I actually don't think that Sam was the guy who was like all in on the sort of like build OpenAI to a reckless direction. And the reason being is because I remember when when I actually saw Sam's talk in London in April. So he was hosting like sort of like a live sort of like private closed gathering, and in that closed gathering, he was actually for AI regulation and making sure that AI was controlled. So it's an interesting dialectic because on a couple of the more background information I saw about it, it was a tension between like those that wanted to take it as far as they possibly could, and those that wanted to, you know, kind of like have a more balanced sort of conservative, all right, don't let AI like sort of cross the guardrails. But I don't know where Sam's point of view comes into that, because the original public consensus, oh, Sam wanted to build it, you know, to F all, but Sam actually, I don't think really believes in that.
Yeah, and I think he's one of the people that has come out talking about the dangers of AI, right, and unfettered AI. So, to your point, it feels like suggesting that he wanted to build, you know, this behemoth that essentially was going to, I don't know, whatever, remove all jobs and get rid of, humanity, or like, you know, pose a significant risk to humanity, feels like it didn't necessarily fit with that narrative, right? And Eghosa, I mean, given that you kind of know him, what would you say?
You know, a few years ago, we built a thesis around AI governance, the need for AI governance. Right. And a lot of the VCs who are out there now shouting about regulation and so on and so on, regulatory capture and the like, were very dismissive about the need for AI governance. Right. So you're always very careful about the positioning and the narratives, right? You know, one of the things I like to remind people is that if I want to control the narrative, I will bring the issues up.
Yeah.
And then
then I can,
I will shape them, right? You know, the classic, you know, I climbed the wall and they pulled the ladder behind me.
Yeah.
Right. So forgive me if I don't, you know, go screaming into the void that, oh yeah, Sam was all about this and that. Look, I have no idea. There could be a series of head fakes for all we know.
Yeah.
Right.
Well, this is the other kind of hot, like, you know, spicy take, is that essentially this was all kind of, you know, engineered by Satya Nadella somehow to like create this massive head fake, you know, drum up a whole bunch of press and talk around OpenAI and what was happening. And obviously Microsoft had, I don't know what it was, like 7-8% stock bump or whatever, when he announced that Sam was going to be joining them, and now, you know, from that, you know, Sam and Greg joining Microsoft, to now Sam and Greg back at OpenAI. It feels like, you know, as this article suggests, TechCrunch, right, Microsoft has been the only winner here. Like, what's your take on that? Because because we also had like several of the private investors, the VCs, you know, coming out saying they're absolutely shocked that this had happened. They had no clue. They didn't have any idea. It was also a question why none of those VCs were involved in the governance, right? Like, because typically in these sort of situations, significant investors, you'd expect to have kind of a seat at the table, right?
So the question is, how many tables should there be?
Right.
Right. So one of the mechanical problems, I think, with the structure is that everyone always thought that only one board of directors needed to be in place. And I don't think so. I think the for-profit entity, in fact, I think every entity
should have had a board.
Should have had a board of directors.
Yeah.
Right. And the way and the composition of each board will have reflected sort of the dynamics of whatever that entity was doing.
Yeah.
So if Microsoft was going to be on the board, whether as a director or an observer, it would have been in the for-profit, which is where they had 49%.
Yeah.
Right. But now, you know, having worked at a big company, I can tell you that, you know, board seats can be problematic.
Yeah.
Especially when you're in the U.S. The U.S. is an unbelievably litigious society.
Yeah.
Right. And so what then happens is, you know, lawyers sit down and go, oh, big target there. Let's go after that target. Right. And so you always have to be very careful about how involved you're in governance. And then, you know, AI is still it's somewhat complex, right? It can be very emotional. Right. And so what also happens is that then, you know, with emotion comes politics. And so what you will find is, you know, Microsoft it's not out there looking to get targeted. They've gone through that process. Satya is as good a founder CEO as a non-founder CEO that I've ever seen.
Yeah.
Right. He's absolutely brilliant. And so, he also understands the dynamics, right? Both the stuff that is visible to us and that is maybe not so visible. So OpenAI represents plausible deniability and execution for the AI strategy, right? And that's great.
And
But
actually not sitting at
so you
that
don't-
table.
I wouldn't be in a hurry to be on the board of directors. I just wouldn't be.
Yeah.
Right. But I want to get all the benefits of it. And so I think from the OpenAI perspective, right, eventually sort of there was a mismatch of objectives, of vision, right? And like I said, if Sam's going to be on the board, I don't think he needs to be on the board of OpenAI, the nonprofit.
Got it.
I think he needs to be on the board because that's really where his ambition is, which is the
operating company,
the operating company, and the for profit.
Yeah.
But that for profit needs to sort of report to and of course that 9-person board or whatever it is. Everybody keeps talking about AI for humanity, and then you look at these boards and you're like, you don't represent. You're not even a representative sample of humanity.
Yeah.
Right.
It's actually gone further the other way now.
Yeah,
I think
exactly.
they've kicked off the women from the board, right?
So you're not gender sort of sensitive. You're not race sensitive. And then of course you talk about the impact of AI and bias, right? And that of course you tend to find out who's going to disproportionately get impacted by it. So there are lots of these dynamics, and it just feels like everybody's very tunnel visioned about it, and they need to stop. Everybody needs to pause, take a step back and figure out, okay, what exactly are we trying to achieve? I mean, there's some really great technology there, but I also know that there's fantastic technology elsewhere.
Yeah, for sure. Well, I mean, we know Bard, we know Grok has now come out of Twitter. We got a poll about to go up, or has gone up on the chat for all of you listening at home. Should Sam be on the board of OpenAI, or should Microsoft have been on the board? What are your thoughts? We'd love to get your thoughts and comments and questions as we keep going on with these conversations. I think, maybe to not quite wrap up this question on OpenAI, but just a general question, I guess. I had Adam Liska in the studio with me yesterday. Adam is the founder of Glyphic, but previously was with DeepMind, and prior to that with Spotify. This is a guy with, a bachelor's in computer science, two masters of science, and a PhD, right? All in cognitive language theory and neurolinguistics. Well, maybe not neurolinguistics, but artificial intelligence in general. The reality is that the pace of change that happened in the artificial intelligence space, was much faster, I think, over the last couple of years than anyone expected it to be. B, the fact that we moved from looking at machine learning over numbers, data, etc., to natural language, so text. And you and I have talked about the semantic web, and as a platform, obviously ChatGPT has taken the world by storm, right? So now, assuming that the drama, the psychodrama, the kind of, Beverly Hills 90210 episode here at OpenAI is over, where do we see this going? Because the other thing that was really, I think, interesting was just how many of the OpenAI team came and backed Sam. So they obviously buy into his vision.
They had 90 billion reasons to do that.
They had 90 billion reasons to do that. But and actually that is an additional question, is that secondary funding round going to go ahead, do we think, or not?
The word is that it is.
Interesting.
It's a small round, so I think if you look at the round, you sort of realize that if I was in Sam's position, I would do that round. It's 300 million, 350 million. It's just a marker round.
Yeah.
Right? Because I think what's going to happen is it's probably setting up for another round where it's going to be another 3 or 4x from that number. But then he can now actually get much bigger investors, could bring folks from the Middle East, bring folks like SoftBank and whatever it is. So this round at 90 billion is a marker round. It's just, it's a head fake. Don't pay too much attention to it. But, for 700 people, $350 million distribution.
Yeah, kind of.
It's
transformational money.
Absolutely, right? So, but, everybody's talking about sort of, the cult, right? And it comes back again to when you think about the very best companies, technology companies, that first 10, 15, 20, 50 people, right? They talk about how founders need to essentially be running like mini cults, right? The mission needs to be akin to religion.
Yeah.
Right. And then people are just willing to just give you everything they have and more. And I think, with OpenAI, you're seeing that. But what I think going forward is that, it has emphasized a few things. One is that the need for open source contributions to AI front and center.
Yeah.
Absolutely front and center. The second is that you're now getting more and more voices involved in this. Before we were sort of like, oh, yeah, this is interesting. It's a small thing, the Valley thing, and then, and then a few folks playing with ChatGPT. But now people are saying, wait a minute, what does this mean to me as an individual, as a small business, right? And, I'm really grateful for that because if, you'll see Microsoft, I was listening to an interview by Satya. He said 40% of the world's global enterprises are testing Copilot, Microsoft's Copilot.
That's like ridiculous.
Which is just incredible.
That is, yeah.
But I think after this OPA, I think it's probably 80%.
Yeah. Well, everyone woke up and was like, oh, well,
Right.
what have they been doing?
Yeah, so there's marketing, there's
Yeah.
a potential adoption, but I think there's also going to be a little bit more concern about what does this mean for us. And I think this is good because now we're going to get a bunch of people, chiming in that weren't before.
So let's try and answer that question, Jonathan. From your perspective, where do you think this is going? Like, so forgetting the OpenAI debacle, but like, where does AI go from here? Like, what do you think you're going to see over the next couple of years? Either transformational or presumably transformational changes in the way we use AI or in the way, we think about the use of AI.
So I'm probably going to say a whole bunch of things that seem very paradoxical to each other because that's a lot of the things I've been hearing, especially, from a lot of the insights I heard from going to NY Tech Week, right?
Yeah.
Which was about a month and a half-ish ago, right? So I think first off regarding AI like regulation, it's a tough one because although AI regulation is needed, right? When I first think of AI regulation, particularly, some of what the EU has been doing, right? I think back to some of, if you remember Michael Jackson's tweets where he talks about how the over-regulation of AI,
let's be honest, Michael Jackson really dislikes regulation in Europe.
I mean, and to be frank, like if I had to institute some of my opinions, I'm not the biggest fan of over-regulation either. I'm a fan of regulation when necessary, but I don't like the idea of over-regulation to the point of stifling founders.
Sure.
And so I think I tend to agree with some of Michael Jackson's takes when he talks about how the over-regulation of AI will stifle AI innovation and the ability for really talented AI founders to be able to build something great in Europe, which will be great for the continent. At the same time, what is needed is some sort of regulation so that the tech doesn't go out of control and ruins people's lives and stuff like that, right? Now, from what I've heard in the US is quite interesting, right? Because attending a couple family office events, right? I think a lot of investors are getting frustrated with what they call ChatGPT reskins, which is basically a lot of so-called, all right, nice jazzy AI decks that don't do any that, or basically if you look deep into the services, all just ChatGPT plus 0.5. And so what a lot of at least family office investors, what I've noticed that they want is something much more substantial than a simple ChatGPT reskin, which probably comes from the power of data sets.
Yeah. Well, it's and again, you and I talked about this. It's internal. It's the biggest use case is capturing the internal information in the business, not the data that's outside. The data that's outside is everywhere, right? If you can capture, the decades, centuries potentially for some businesses, but certainly the decades, years and decades of information that a business has inside, and really use that to make your business more efficient, that's where your cutting edge is going to come from, right?
But it's not trivial though, because I think Chamath made a comment yesterday, and I could not resist but respond to him, and that is, look, at the end of the day, it's been obvious to people who have been in the business for a long time. So you made a very interesting comment about how fast the last couple of years sort of have moved in, and it's 20 years to become an overnight success, right?
Yeah, absolutely.
And what you find now is that, there was the initial ChatGPT excitement, which was really great. Certainly got people sort of, lifting their heads above the parapets. But the truth is that data sets are going to matter, right? That's the bottom line, right? 95% of the internet sits on of knowledge, knowledge that's sort of been digitized in various forms, sits within intranets,
right?
Right. We're no way near starting, and so and the point I made to Chamath was, look, at the end of the day, for companies to be able to get access to that, you have to be a trusted provider. That's the bottom line. And, with all due respect, startups that just woke up yesterday went through some accelerator and said, the AI companies, I hate to break it to you, but you are just on the wrong track. enterprises are not going to really support you.
Yeah.
Right. And so what you have to do is go and earn their trust. And that takes a while.
Yeah.
Because, it's very competitive out there. And so I think when we talk about sort of, what does AI look like? My point to Chamath was, look, in the consumer space, right, pulse data. Mm-hmm. So folks who own pulse data.
Yeah.
So whether it's Amazon Shopping or WhatsApp or Facebook or Insta or TikTok, right, or even Google Search, right?
Yep.
Those guys are in fantastic positions, right? But for the enterprise, you're going to have to do two things. You're going to have to get access to their proprietary data, and then you're going to have to overlay it, and then you structure that. You have to structure that.
Yeah.
And then from structuring it, you can now sort of build knowledge graphs.
It's a whole pipeline problem, right?
And once you're able to build the knowledge graphs, that's game over.
Yeah.
That is absolutely game over. So you have to think what the companies are going to do that, right? And that, for us, we think that's the big outcome, right? So eventually these LLMs get, large language models, whether they're large language models, small language models, whatever it is, they get commoditized.
Yeah. Well, they're already being commoditized.
They get
right?
commoditized.
Yeah, and equally, not only would they get commoditized over the longer term, but OpenAI has already released a bunch of stuff that has already kind of killed off like all of these startups that were sort of just trying to build on OpenAI with very general application, right? So, I think, my take on this is I probably not particularly contrarian. It would probably fall within what you were saying. And Jonathan, obviously, you didn't finish quite what you were just saying. But the reality is that these large corporations, the larger players playing in the AI space are going to continue to see the opportunities way ahead of others, right? I think there are niche products that may be built, right, but aren't going to be the transformational businesses, right? And this kind of comes to what we're going to talk about when we talk about Sam Lesson's post is, today the businesses that are being built, are these going to be the generational businesses of tomorrow? Like, one could argue that OpenAI is already, has pretty much launched itself into that spot by nature of the ubiquitous application, usability, adoption, etc. It has become like, it is a platform in the same way that, as an example, there's a change from using Google Search to moving to OpenAI is the same as like going from Nokia to the iPhone, right? Like, you're seeing that kind of transformational change. So for me, what I think is going to happen is those larger players in the AI space will continue to innovate. There will be lots of kind of fragmented small startups trying to build around that space. I 100% agree with you. Like, most of them will die. Most of them will not get funded. Most of them will struggle to find a use case. I've looked at it myself in various aspects and sort of said, well, I could do this, but there's actually not, because again, to your point, the only thing that matters is the data. If you don't have access to that data, it's really hard to build anything that's going to be proprietary and really, really valuable. And then there's a bigger problem. Like, again, when I was talking to Adam Liska yesterday, we talked about, they're building a revenue ops co-pilot, right? And asked him, but okay, so are your models being trained on the whole set of data or just the individual company data? He's like, no, it has to be the individual company data because of obviously the risk of data privacy, right? So they're sitting on all this data which they can't actually use, right? It would actually make their overall model a million times better, but they can't do that, right? So then the question is, well, who has that data? And OpenAI did like the smart thing. They essentially, obviously they ingested the internet, but then every user of ChatGPT is essentially just piling data upon data upon data into the system, right? So,
but it's been blocked in the enterprise.
It's being blocked to the enterprise, yeah, exactly. Right. So when they get I guess to your point, right? When you are able to access, structure, and use that enterprise data, to your point, it's game over, right?
Game over.
Everything changes. So let's actually move on from OpenAI. Unless you have any closing thoughts, Jonathan, you want to add?
I think I want to save them for the next article.
Okay, cool. Because I think this is interesting. So we're going to talk about Sam Lesson's deck that he released. I think it was a couple of months ago now, if I'm not mistaken.
Yeah.
But in it, he talks about the essentially the move away from the venture capital factory model, right? So, things that he talks about, we see here, $1 billion seed-backed small businesses for the win, right? So what he's essentially saying there is, businesses that are capital efficient, that don't require ongoing funding, are going to be the winners in the coming epoch. The 10 billion factory farm unicorns and multi-stage stage firms designed to build them are effed. We're going to talk about SoftBank and Tiger Global as well, but that essentially is what he's talking about. And the 100 billion platform wins, they were never manufactured, never can be, right? So I kind of agree. Those platforms he's talking about, the likes of Facebook, Google, Microsoft, etc., Apple to some extent, but those ecosystems that were almost once in a lifetime, right? It feels like we're not seeing those sort of platforms arising in the same way that we did in those times. Like, are we ever going to see another Facebook? Are we ever going to see something as large as that evolve out of the current ecosystem? So I guess from my perspective, as someone that sits as a CFO, that, we operate CFOs in venture-backed funds, venture-backed companies rather, we would always argue for capital efficiency, right? Like, I've never understood the kind of burn at all costs methodology. The one take that I have that's slightly different, Jonathan and I were talking about this slightly earlier, was I think there's a difference between startups that are capital efficient, and capital intensive startups in the deep tech space, which may still be capital efficient, but are capital intensive, right? You can't build certain types of hardware, maybe some types of software, but certainly types of hardware. If you're talking about medical devices, if you're talking about chips and image sensors and these sort of things, they take a lot of capital to get off the ground before they get to commercialization. That doesn't necessarily mean that they're not being capital efficient. It just means that it takes a lot of capital to build them, right? So that's the only kind of point of slight differentiation I'd have with him. But again, Jonathan, what you raised this as something you want to talk about, so have at it.
Absolutely, yeah. I mean, so, when Aarish and I were talking about this earlier, right, we had our two definitions of, capital efficiency and, kind of like tying that into, like how investors should best position their strategies particularly when it comes to the two definitions of capital efficiency. And I think the answer is honestly, I think the answer is both, in the sense like both are winning strategies depending on how you execute on them, right? I think, there is space for, great deep tech investors, great, medical device investors. I think as long as you have great knowledge in domain space of deep tech and medical devices and, things that are capital biotech, for instance, I think there's, a great opportunity in the market for investors to come in, see great pain points, see great fundamental businesses in that area and put money in. More or less, I think the area that ties into a little bit more about what I'm passionate about is capital efficiency in the area that building something innovative that will solve a heavy pain point that does not require a lot of money to start. So I kind of see it from a two-pronged point of view. It's like both businesses that don't require a lot of burn and businesses that don't require a lot of money to get started with. And that actually stems a little bit from, my passion with alternative capital models, which stems from indie VC and Calm Fund's original thesis, which is, okay, how do you use creative instruments to fund the next generation of capital efficient founders? And it's this idea that the next great successful founders may or may not go to build like massive unicorns, but they'll use very little money. They may not raise beyond a proverbial seed round, which is $500,000 to $750,000 or pounds, depending on where you're located at, and build that to either 20 million a year, 30 million a year, things like that. And that's where Sam Lessin coins the term the not so lifestyle business, which is okay, this is something that falls slightly short of a giant 200-300 million pound dollar exit, but this is something that has generated product market fit. This is something that has generated great successes for the founders. And this is something that, ultimately has demonstrated that this founder is an elite founder and has solved the problem.
Right. So this is an interesting one, right? Because ultimately what you're talking about is a change in the whole venture capital mindset, right? Mm-hmm. So lots of people, lots of founders, lots of investors, angel investors certainly, and lots of, I guess, man on the street, right, would say that why doesn't venture invest in businesses that can have the 100, 200, 300 million outcome, or the, you know, even the sub 100 million outcome, like 50, 60, 70, 80, because that's transformation for the founders. But that's not how venture works, right? So how do you get away from the venture structure? And Eghosa, I'd love for you to put some thoughts in here, because fundamentally, venture capital is predicated on the fact that you take money from LPs, you invest their capital over a relatively long time frame, in the sense that, you know, it's still 10 years of capital being tied up. Okay, capital calls will happen over that period. It may be, you know, 3 years or 5 years or whatever, but your capital is tied up for, you know, up to 10 years, if not more. And because it's tied up for those 10 years, the risk profile suggests that you need a large enough return for it to make sense for you, which means you need the outsized returns. Equally, you have power law, right? Which means that you are expecting a very small number of the businesses that you back to have those super large returns, and that is the venture model, right? And those returns will not only return the initial capital invested, but will also provide a profit by way of multiples on that return, right? What you're saying is, okay, because you have a model where you back 100 businesses, rather than 2 of them succeeding, 80 of them go on to have good enough outcomes. But the venture maths doesn't work, or am I missing something?
Well, there's 2 ways I would answer that, right? So first, with a slight touch point on the numbers point, right? Now this is coming from a slightly biased point of view, right? And this is no way an objective point of view, but I'm from the school of thought that higher volume with less follow-ons beats lower volume with like much more in like each company, right? That gives you more bites of the proverbial apple. So that's the slight point I'm going to add to that. The second, though, and I'm actually going to tie this into another article that hasn't been listed up on there, and I'm curious to hear y'all's thoughts on it. But the idea that I want to bring to the table is debt is coming back to venture, and it's good that debt is coming back into venture, right? And so this is assuming that every single deal is going to be done on a pure equity basis, which, from my point of view, in order to obviously make things like investing in capital efficiency work, you have to use structures that utilize flexi debt and equity put together. And we'll see, and as we've seen in the US, you know, we see Indie VC, Calm Fund, and Capacity Capital and Collab Capital actually utilize flexi debt and equity and profit share, revenue share, income share type instruments to align incentives with founders, with founders on that end.
So I have a few thoughts on that.
Go for it.
One of them, I think, is that, yes, you're right. We have now been flogged into submission about exactly how venture should look and feel. Mm-hmm. And unfortunately, there's so much, you know, success bias that, you know, we start to get confirmation bias, right? And it's challenging because, you know, I remember talking to an LP and I said, you know, if I came to you and I did, you know, 10 deals and I lost money on 2 and I got like 2 to 4x on the others, he was like, oh, it's not that exciting.
Yeah.
And I'm like, that's funny because that will still average me at 3x, which would put me in the top quintile of VCs, right? But you want exciting, right? So you're selling a very different product. Yeah, you know, and in the market today where I could go to sleep and make 5%.
Exactly, yeah.
Risk-free.
Yeah.
Right? Then the hurdle, I mean, I tell folks, you know, Citrix did it take private. You know, that was a 10% deal. You know, that's a $3 billion ARR business. And, you know, their debt was 10%. Mm-hmm. Right? You know, so by the time, you know, you had, you know, a few others coming in later, I mean, poor timing, it was at 14 to 16%. Right? That's crazy. Right. And so you now step back and you go, okay, so how do we need to think about this? And it gets a little frustrating because I love Bryce and what they would have done at Indie VC and the like. And we have a few of those types of companies in our portfolio. And it's always been driven, when I look at what's common among those companies, is the way the founder views the opportunity. Right. So we have a company that's probably going to do 22 million, going to end this year at 22 million, raise $100,000.
Wow.
Right.
Total,
so,
lifetime.
100 grand. We're the only institutional investor in that.
Wow.
And so people are like, well, what's the exit? I'm like, the exit is the dividend. Right? There is no exit because I'm staying indoors. Right? I just need you to come to where I'm lying down and give me my dividend check every quarter, and I'm good. Right? And you stay there long enough, and that becomes a real fund returner because that's a business generating free cash flow.
Yeah.
But it's not exciting because it's
not the big number.
Oh, it's not some huge exit. And so I think we all have PTSD because we've sort of been brutalized into submission as to how we should do this, whereas we shouldn't really think about it. Even this construct of what we used to call equidebt, where we offer this to a bunch of LPs, in Africa. We're like, look, a lot of very interesting companies need maybe equity for the first 2 years and then wouldn't need it again. Let's go raise a side-by-side debt fund. Oh, no, Eghosa, this doesn't work, and this and that. It was always one excuse after another. Same LPs that are now rushing into credit. And I'm sitting there going, wait a minute. I know I literally told you this thing. Right? And so, what we have to figure out is that there's no one size fits all. And there never will be. I mean, even the portfolio construction, which is, you take a whole bunch of things. It was an incredible podcast that I really enjoyed. I think it was Dave McClure that shared it.
Damn, not one of mine. Okay. That's upsetting.
Very, very data driven. But she was talking about how GPs just get themselves into a bind because they're like, well, we do X and Y, so we write checks of this amount and anything less than that, And
the fund thesis essentially it becomes the
one of their GPs wrote a $75,000 check that turned into $27 million. Right, and that check was not their typical size, but they just wanted to get in. Right, the same thing with with our portfolio. We see some of these deals where I was like, man, I just gave this guy $75,000, and holy smokes, he's on his way to $200 million in revenues. Right, and so you these things don't fit because when we did that deal, I couldn't have told you that.
Yeah.
Right, and so I think we just need to pause and say, and Sam is very interesting. I mean, the other thing, I love Sam, but I hate the fact that it always uses this sort of dark mode, in these things. It's very annoying.
And to your point, I think Sam has sometimes fairly wild takes. I mean, the wildest take I remember him ever having was it was all the way back in August, and he went on this rant about Calendly. I don't know if you guys ever saw that.
I have no idea what it was going with
basically, the TLDR behind that was he was just what sending me a Calendly is really offensive because if you really valued my time, you should move around your other appointments to go accommodate me.
I kind of agreed with him, but that's mainly because I'm really bad with my calendar. But no, so a couple of points that just came up there, right? As both of you are talking. So one of the reasons for the VC model as it stands today is because of the expectation of multiple funding rounds. There is the need to potentially, and some would argue this the other way, but there is the need potentially to own a certain stake in whatever business you're investing in so that you retain a large enough stake as you get diluted down round after round after round, because many VCs or many investors will invest at a certain stage and won't go further than that, right? But if you have the ability to invest in a business in which you aren't getting diluted, right? So you can actually take a larger stake at that initial round and not get diluted by Series A, Series B, Series C, et cetera, and you get to the 100, 200 million, whatever that benchmark may be. Actually, the outcome is potentially not so different, right? Because, in order to, if you've got a 100 million fund, you're investing at seed, in order to exit or to return your fund, that business has to exit for $1 billion, and you need to have retained a 10% stake. Retained, right? Which means you've either invested at 15-20%, right? Ownership.
Right, just gotten yourself diluted.
Right. And then diluted, or somehow or the other, you followed on, right? Potentially is the other way, right? Yep. But that there's a lot of capital essentially being utilized to get to that $1 billion valuation, and actually you could be happier with a smaller valuation with your initial stake remaining as it was, because you're not getting diluted by these future rounds, and therefore actually you need a smaller outcome.
Remember as well that you're swimming upstream because of this annoying concept called multiple compression. Right? So your company is getting more valuable in your eyes because of the revenue ramp, and the market is like, that's cute, but we're pricing these types of companies growing 40% year over year at 5x.
Yeah. Yeah.
If you don't like it, you can go home.
Yeah. And yesterday we were pricing them at 2040x.
Oh, I mean, OpenAI has been priced at 90.
90. Yeah.
Right. So I mean, and that's, these things happen. There will be these aberrations, but I feel sorry. I really do feel sorry for founders because
thank you. We appreciate that.
Because the ground game just is changing in real time.
But I don't think, and this is interesting because I don't think founders have caught up to that.
I think some have.
Sure.
After they've come out of physical therapy for whiplash. But, it ends up that, just even having founders being able to, I'll give you an example. I got sent this very interesting deal last week. And it's an unbelievable founder and very low key. And then she tells you what she's done and you're like, whoa, okay. And she's raising a very small amount of money. Did VC and PE in the last iteration, doesn't want to do anything. Almost didn't want to take the call with me, but only because one of her investors was like, you have to talk to him. And it was so interesting to listen to how she wanted to build this thing. And she wants to raise $800,000, and she thinks she's going to be free cash flow positive next year.
Amazing.
Right? And so you're like, wow, that's interesting. But what's fascinating was that the thing that she cared the most about was, she said, look, I built my last business, 8-year span, unbelievable exit, and I just stopped being happy. Because it just felt like
the pressure.
Yeah. Yep.
Not for me to build a great business and to sell products and my customers
to exit.
But that's it, right? And she was like, this time around, so it became this whole thing where I was like, okay, I'm going to bring a few investors around, and they all share the same values. And it became a very values-driven conversation. Right? And I think that you're going to see more and more of these founders.
I think we already are to an extent. Like a lot of second-time founders that I meet here in the UK and Europe in general, where they have raised outside capital in the past, second time round, they often don't want to. They often will, in any case, because they can. But actually, they know they can also do that slightly more on their own terms. I think a lot of founders, I would include myself within this, I realize late into having raised money that I actually didn't like having investors because I prefer to kind of just take my own path and do things my way and go at my own speed. But it was interesting. I remember having a conversation with someone. The minute you take outside capital, the minute you take capital from an investor, they are expecting an exit, one form or the other.
Yes.
Yeah.
Like that is the train that you're now on.
And obviously the reason why, a lot of us investors put that kind of pressure on founders is because we ourselves are facing pressure from our LPs at the same time, right? We as VCs are kind of like in this interesting position in this V quadrant where like we have obviously like we're investors and we are looking for investors at the same time. So we're both under pressure and we're giving pressure at the same time to make those that are giving us pressure happy, right? Now I'm actually kind of curious to see y'all's point of view on it because like something I've been toying around a little bit and thinking about a little bit is like, do you think there's room or do you think there's a way for like the next generation of VC funds to be fully bootstrapped? Like fully bootstrapped, self-revenue generating VC funds that don't need any LPs.
So before we get to that question, because I think this ties into something Eghosa you were saying earlier as well, which is we've had like these orphan funds, right? Like we've had a lot of capital been raised over the last several years. Often, people have talked about kind of tourist venture capitalists. There's questions as to whether emerging managers will go on to raise their fund 2 or potentially their fund 3. We've had news here in the UK where Stride VC, which is probably one of the most well-known seed stage funds here in the UK, Fred Destin, they've made the decision, strategic or otherwise. I don't know the detail behind it, but certainly Fred's kind of post on LinkedIn suggested it was for after having reflected and sort of thought about where he was in life, he decided not to raise fund 3. One could be cynical and say, well, maybe the environment has not been ideal for him to be able to run fund 3 or raise fund 3. I'm not sure, but he may also just said, well, actually, it is really tough out there to raise fund 3. I don't really want to do that again, right? But you as you said, there are all these orphan funds out there that potentially there's an opportunity to gather those together and essentially run those almost as a fund of funds kind of thing, right?
Exactly. And when I pitched this last year, it seemed crazy, and all of a sudden, we're hearing, some U.S. funds now considering doing it. But it really was born out of a few things. And to be honest, I think, during the pandemic, I hit, I think, probably my lowest point or highest point of vulnerability, where I really started to question whether I was having fun anymore.
Yeah.
And I really wasn't.
Yeah.
And it was less about, I love venture. I don't know how to do anything else. So it's, this is my thing.
That's why we're sitting here at 6 o'clock in the evening talking.
Right. But I felt a lot of people were coming in and just abusing.
Yeah.
The craft of venture.
Yeah, we're going to talk about Tiger Global, and it's like one term sheet a day.
I mean, and I have some stories, but they were just abusing the craft of venture. I thought it was really easy, and it was all about markups. And, and I think, I stopped having fun. It was really a drag to work, and, but, eventually, when the market slowed down, I started having fun again, because I was like, oh, finally, we're going to get rid of a bunch of these jokers, right? And, I really find these sort of quality founders who know how to do this work, and then, who understand.
Well, you had a two-sided problem, right? You had all the capital, but then you also had like a lot of founders that were building inconsequential businesses.
But
right?
The last time I was here,
yeah,
I did tell you that half of the founders we saw should have been employees.
Yeah.
If not more.
Yeah.
Right. And, people thought it was controversial. And I was like, well, time always tells. Right. So I think as we move now, right, there's something to be said for the number of firms to compress. Right. There's something to be said for the number of bets that get made.
That slowed down dramatically.
There's something to be said for it, right? You just get better quality out of it. You're not taking sort of haphazard stuff, right? But you do also want to be able to get to a point where you can distribute opportunity, right? And so geographically or howsoever otherwise. But I do think, stepping away from this, I do think that there are going to be some fascinating changes in the next year or two. And I think we talked a little bit about it at the beginning of the program or before we started, which is, what is the big structural change that's coming, right? In 2024, is markdowns.
Yeah.
All the markdowns that people were delaying and the like, all the games GPs were playing, apparently LPs too, because some of them actually get paid
private equity funds flipping portfolio companies into the next fund,
right?
To create the markup,
or continuation vehicles, and a bunch of things. Everybody's playing all these sort of games, but time always tells. Right, and at some point in time, definitely by midpoint next year, everybody's going to have to mark down, right? I mean, there's a deal. I mean, I'm going to change a few of the numbers, but it should be able to give you some sense of the horror that was done at in excess of 300 million, on a post-money basis. And when it was done at that, the company had a bunch of pilot, deals in place. I think 200 grand, right? And
200 grand in revenue with a 300 million
pilot revenue, and they now come out. They've raised north of 40,
right?
And they now come out to raise and ask a very simple question, which is, all right, so what are the revenues now? So the revenues are more than one, less than two, because I need to make it very generic. I'm like, okay, so we got a problem.
10 million.
I was like, we have 8 max.
Yeah.
Right? And we have a problem now. And I said, okay, so guess what? You need to go tell your lead VC that they're going to have to bridge you.
Yeah.
But here's what's interesting. Because we all know.
But they're going to have to bridge you to 50 million in revenue.
Oh, they're just going to have to bridge you. I don't know but they're going to bridge you. But what it was most interesting was, I was like, here's how the deal is going to look. It's going to be an uncapped note. And they're like, founder was like, why on a cap note? Because I was like, because this VC cannot take this markdown. They can't absorb it. Because I know what's going on in that fund. So they're just going to give you some money on a cap note and pretend that your pretend valuation is real. Right?
They're too worried about their IRR or MOIC, what's going to look like in the next deck.
Well, they're looking for the next fund.
Well, they got to
pretty
raise,
much.
Right?
I mean, because it's crazy how you mentioned that, because almost like every single like family office forum I've ever been into, right? There'll be like these like funds pitching like on the front screen, how they like invite like funds to go like sponsor, pitch and stuff like that. And like every single fund I've ever seen,
it's not just startups that have to go and pitch at an event. Yeah.
So every single fund I've ever seen, they put like these astronomical numbers. Their MOIC is like 8x.
Yeah, I was going to use that number.
It's nuts.
And then
but the only thing that matters is DPI. Like this is the thing.
Exactly right.
LPs will come to us and they were like, "Well, why is yours 3.8?" Right, I'm seeing other funds at 8, and I was just like,
"Have you dug behind those numbers?"
And I was like, "Man, I know there's a meme that I need to bring out for my response."
It's hilarious.
But that's been the shift, and everybody seemed to be playing a game, and that I think that's really why I said I stopped having fun.
Yeah,
because it felt like I didn't know what the rules of the game were anymore.
Yeah,
right, and you're always supposed to play the game you made on the field.
Yeah.
Right. So I was like, you know what? I'm not going on the field. I'm not interested in that. And I think it's been just because I just stopped talking to LPs. I was just like, I don't want to talk to them because I'm not going to lie, and I say what's on my mind.
Yeah.
Right. And so I'm just not going to do that. But I think we're going to have a bunch of the folks I feel the most sorry for are a lot of founders, because I think next year we're going to have a lot of startups with names on the cap tables that literally, when you call, there is no answer.
Shot, yeah.
No, nobody's picking up.
Yeah.
There's nobody at the other end of that call.
Yeah.
Right? And that's problematic. Right? And then, of course, the final point I'll make is, we're in the middle of doing something now. Let me tell founders this, really, really, really critical. If you think there's going to be a recap necessary for you to get new money in, you need to start the process. Because I run into a lot of VCs who, because they're buddies with existing investors, no matter how much they like that company, they will rather be I play golf with X than go in there and fix this cap table.
Yeah.
Fixing cap tables is corrosive in the same way pivots are corrosive. Right? And
it's necessary pain.
Necessary pain, but boy, oh boy, it's going to leave a hole in there.
Yeah.
Right? And so trying to tell founders how to navigate this, and I think you're right. A lot of them are going to come out in January, February, March. There's going to be a ton of folks trying to raise money. I mean, if you have a Series A or Series B fund and you have a ton of capital, oh man, 2024 is going to be, it's like shooting fish in a barrel. Oh, it is going to be fun.
But, and this is where, so like the FT had an article, we're seeing, and again, this goes to the point about the roll-up funds, we're seeing VCs now raising buy and roll funds, right? So they think there's going to be businesses at Series A, maybe even Series B, that are kind of at product market fit, but haven't been able to kind of get scale, don't have, have some decent tech, have probably overhired, burning too much. Founder doesn't know how to run that business anymore. No one is going to invest because no one's coming into those. There's too much other stuff out there. To your point, or we've flipped back to like.
But Aarish, you've done this finance thing. I just give you an example, right? You have a company that's between 1 and 2 million in revenues.
Yeah,
has raised over 40 million. So you want to go buy it and add it to the roll up. Exactly what price will you pay for it?
Oh, I mean, like sub 2 million probably at that stage, right? Like the only way you're going to be able to do that is basically buying it as a distressed asset, right? So you are, exactly as you say, you're doing a recap or you're doing a full buyout, right? Which means, hey, Mr. Investor, whoever's on the cap table now, you're zero. You're wiped out. You recapitalize. So you essentially buy the business for pennies on the dollar, right? You make the founder whole to some extent if the founder needs to be retained, or you put in your own CEO. In fact, like what I think we're going to see is you're going to see funds like this deploying their own management, much like private equity, right? Get those businesses into ship shape and then sell them to an acquirer that can actually use their tech and get them off your books like within a couple of years. But you can only do that if you recap it. You can't do it at the valuations they're raising at. Like that makes no sense. Right?
But it's only going to be a very narrow window for those types of strategies.
Yeah.
Because look, by the end of next year, you can expect that, risk-free rates, they don't stay at 5.
You think they're going to drop?
Yeah, they're going to come down. Right. And so that becomes interesting because further away.
Then do we see like a reversion to the zero interest rate type type activity.
I think for a lot of reasons, particularly because of sort of the directionality of sort of inflation generally, I don't think there's going to be a reversion to
I don't think we'll go to zero. But
no,
yeah.
right? But you come down, maybe you get to rates in the 3 to 4, right? Which of course assumes that your inflation rate is somewhere around there because your rates should correlate to whatever your inflation rates are. But that means that you go from what we were, which is fully risk on, nobody cares, everything go, to fully risk off, nobody wants to take anything, right? To some happy middle.
Yeah.
And that I think is sort of where I think we have to start thinking about even, maybe not 2024, but 2025.
Yeah, it's the next 3-5 years.
Correct.
Like, and Jonathan, I mean, like your question, can you bootstrap a VC fund? I mean, I think that's an interesting concept. My take on it is, in order to make, I mean, that to me feels more like an angel strategy than a venture strategy, in the sense that in order to have enough bets at the table, in order for it to make economic sense for you, and because the return cycles are so low, right? So this is the other problem. Like if you bootstrap, you're not going to see returns from those investments, even if you're looking for a cash generative business, for probably 2, 3, 4, 5 years, right? So you've got to somehow fund yourself for the next 5 years before you. So I'm not sure you see a fully bootstrap fund, but I think definitely maybe you see rolling funds, maybe you see a slightly different structure emerging, or you see more syndication. I honestly don't have the answer myself.
I was going to add something, because it was funny when John was talking about it. I was like, oh, that could be quite clever. But you run into one sort of structural problem, is what I call the x-axis, y-axis problem of the DTR and STR. DTR is dollars to realization, right? How much do you need to put in for the founder and investor to realize whether or not there's a real business here?
Yep.
STR is speed to realization, which is,
right, pretty
exactly
much.
how long does that take, right?
Yeah.
And so you have to figure out where in that do you need to sort of sit, and you can't drift.
Yeah. I think it's interesting you mentioned that, right? Because I think when I was thinking about that concept, I think from like a pure investment standpoint, I think it would be tough to do, right? But I think what I've seen out of a couple funds, and I have to like dig a little deeper into like any couple of funds that have like experimented with this, but basically like just funds that have like sort of like tacked on an additional element of like, okay, so here's the fund part of their strategy, and then here's like the other side element of their fund where it's actually like a bootstrap SaaS business. So it's kind of like a bootstrap SaaS business and a fund at 2 in 1.
Yeah, I mean, I think the evolution from where we are today to where we're going. I mean, like, I think if anything from this conversation and from everything that one can read, and we didn't touch on Gil Dibner's article where, essentially he also talks about this kind of, at Angular, they're reverting to funding seed businesses that they think can get to cash flow positive quickly and don't go through that whole kind of venture round. Well, obviously, if that is the way that founders and businesses are going to move, then venture has to kind of follow that, right? Like that, which he's going
to be raising new funds every 8 years.
Yeah.
I mean, every 8 years is a dream, because like I feel like most funds are like every 2 or every 3
right,
years.
That's what I'm saying.
Yeah.
But he'll be raising funds every 8 years because
he won't see the realization.
No action.
Yeah.
For a while.
Yeah.
Right. I mean, that's just the truth of the matter. So you have to decide, which goes back to sort of the fundamental decision you have to make, which is, are you in it for the fees or are you in it for the carry?
Yeah.
Right. And if you're in it for the carry, are you willing to struggle for a while? Because when the carry does happen for these types of businesses, it's nice.
Yeah.
Right. I mean, you get a carry check, you're like, whoa. So that's what this game is about.
Yeah.
But it is, those two things are almost in horizontal opposition.
And it's fascinating to see some of like, I've actually in NY Tech Week, I remember meeting a couple of emerging fund managers that were like running these like 0-30, 0-50 models, where like they're literally like just living off of their friends' couches, and they're like, I'm gonna take nothing off the management fee, and I'm just gonna take this fat ass carry. Which is kind of interesting. To like, it's bars, but like it's hey, if they got like conviction. It's pretty nuts.
I mean, then we start getting into some of the structural problems with venture, right? Like, how do people with no capital get into the game, right? Because 0-50, yeah, okay. If you've got friends with couches that are willing for you to stay on them, great. You're probably either very young, your friends are very young, and you've probably got some money that you've inherited or something that you can invest, right? Like most, I mean, like I could not afford a GP commit today, like no way in hell,
very
right?
few folks can.
And very few people can, right? So maybe there's a structural change that needs to happen there. Let's shift for a second, because I feel like we've explored this quite deeply, and I think, I mean, the upshot is, and we'll talk about what our takes for the next couple of years are going to be, maybe at the end of the show, but I think they're probably very similar to what Eghosa just mentioned. But the other crazy stuff has been what's been happening with these behemoth hedge fund or quasi hedge funds or super venture funds, SoftBank, Tiger Global. So SoftBank posted a 6.2 billion quarterly loss as a result of the WeWork collapse, right? Not only that, but they've been accused of destroying a social media app to protect their reputation. They've got all sorts of stuff going on. The sale of Arm kind of removes their safety net, right? Like that was their last hope. Like that was carrying the kind of fund. So what the fuck's going on? Like what is happening?
So I think probably my take of it is probably going to be a little bit less sort of like numbers related, in depth related, as Eghosa is probably going to give. But it's interesting because when he posted these articles, the first thing I did is I took like a background research and tried to dig up all the SoftBank Forbes articles that were actually written 10 years ago about when, or I'm trying to remember if it was 10 years ago when SoftBank actually made its first investment into WeWork. And that was the article when
7 to 10 years ago.
Yeah. So, and that was the article when SoftBank was talking about all the good things about WeWork and how WeWork was disrupting the office space industry, how like it was creating this like sort of like modern day sort of like environment where like workers wanted to gather,
the future of work
and all that type of stuff, right? And it's very fascinating to see them flip their position like 5 years after that. And it's like, and
one of the articles I didn't put up here, like I think they put in another 1.5 billion of debt,
which is nuts. Absolutely.
But also I think there's talk of them rescuing WeWork from administration now. I might be wrong there.
If I was their shoes, right. I would.
I think
pennies on the dollar, right?
Right. I think the biggest takeaway I got from it is, as much as like we're able to see with a clear view of like, oh, SoftBank was wrong, SoftBank shouldn't have put a penny into WeWork. I think if it was 2014, 2015, I think a lot of us could have been easily like been fooled into dumping money into WeWork.
I don't know. I don't know about that.
I think so.
I don't know about that. Like, I mean, a lot of us at the time were like, this is a office. This is a real estate business with a tech valuation. I think the vision that Adam Newman presented, maybe that's something that people.
Oh, it's very compelling.
Yeah. That's maybe something.
But I think the biggest issue when you come out of SoftBank is that there were two themes, and I think I agree with you. I completely disagree with you about we will have fallen for that, because there were two big themes I never signed up for. One was the weaponization of capital, which SoftBank, absolutely.
Here's 100 million.
Oh yeah, right. You look what they did with Dogster and whatever those 300 million. I mean, just absolute moronic stuff. The second was the whole construct of blitzscaling. I love Reed. Yeah. Right. Love Reed. He will have made me a ton of money. My people at Intel will have let me do his deal on LinkedIn. But the blitzscaling thing was just wrong. Yeah. Right. And it goes hand in hand with the weaponization of capital, which is we will blow away into this thing and we will dominate and we will win.
Well, it's a counterpoint to the whole capital efficiency argument, right?
Yeah. But I will say, when you look at someone like a WeWork or you look at an Uber, right, the truth of the matter is that, I pointed out on Twitter that, no one's paying attention, but Dara.
I saw that. Yeah, he's created as much value.
As much value as was created before he became CEO. But, those companies in a non-ZERP environment
would never have existed. Yeah.
Now, this is interesting that you bring it up, because when I say a lot of people versus a lot of people, I don't say that the people that put money into WeWork at that time were correct, right? I'm fully on your side. What I'm saying is this is a tendency for human nature to skip over the important details that y'all have mentioned and to look at like
No,
all
that,
the flash metrics.
Well, no,
I
that's
think
your that is your fucking job. As
I
if
think
you
that's
are
what-
investing,
that's
that
what
is
I'm
your
bringing up.
goddamn job.
Oh yeah.
That
So-
Look.
It's a fallacy of human
there's
nature,
another
you know,
example. Again, no names. This was Sam Bankman-Fried at FTX.
Oh, yeah, jeez.
Right?
I mean-
He's trying to raise money. Right? Goes to a really experienced VC, very successful, and these were the words of the VC. I was taken by him.
Okay, but why?
No, just
Doesn't
personality,
matter.
vision, whatever it is, right? But luckily, he was, and I think it was asking for $300 or $400 million, and he would have done that deal.
Yeah.
But because he had a structure, they were like, "Look, this guy's running around with PDFs of Excel forecasts."
Yeah, an
and
Excel
his debt-
balance sheet with like
Right. No,
some-
PDFs though.
Oh.
No,
not even.
No,
okay, fine.
PDFs.
Okay.
Right? And he's giving us 5 days and all that nonsense, right? And they paused him. And, he was lucky. But the truth of the matter was, there were so many people that
Didn't have the structure or didn't care, wanted to be in the hot deal.
the FOMO.
But this
The-
is
the bit.
so this is the big thing, right? Like and part of this is the cult of the TikTok investor or the Twitter investor. Like so build a massive audience, raise some money, and somehow, and okay, this is different from SoftBank for sure, but somehow that gives you legitimacy to go out and invest other people's money. Like something is really wrong there. Like I've been in finance for whatever 20 30 years, right? And running businesses. I understand what good looks like. I understand what good at scale looks like as well. And I would still be nervous investing other people's money. Like I would second guess myself. Now, okay, that may also be just because I haven't put money to work or whatever, but anyone whose assumption is that or anyone that came up who essentially said, well, I'm an investor because I've got this amazing audience, which means I get deal flow.
Right.
Well, guess what? Guess who that deal flow is coming from, right? Like those are people listening to you who just assume that you can essentially boost their profile by investing in them. Doesn't mean they got a legitimate business. It means, hey, I can get some free marketing out of coming into this, right? So I think the problem, and this comes back to the tourist VC thing, the problem is there's been too many people who are like, you know what? There's money out there to burn. Let's go burn it, right? And so it was systemic.
But there's an argument against that. I talked a little bit about Tiger, right? Who was, Tiger, another firm that was they did whatever they needed to do. They ran. Look, at the end of the day, people were like, "Oh, Tiger did this, Tiger did that," and I was like, Tiger delivered a product that LPs were looking for. When they raised that $12.7 billion fund, they sat down and said, "Look, the LPs out there that write $500 million checks, they don't know how to get into VC. Right? They just don't, right? Because they're not going to put $5 million into it. It makes no sense.
It's too small. Yeah.
So you give them a product that says, "Oh, look, it's VC, it's this, it's that. We just, we have this sort of themes and whatever it is, and and copy and paste and pattern recognition." And they're like, "Great, no problem," right? The problem, I think, was we never stopped to ask, who is being served here?
No
right?
one.
I mean, who is being served here? And the game was raise money, deploy it as fast as possible, come back again, right? And
take your fees.
And the fees are just tremendous, right? And so now look, at the end of the day, Tiger, we saw them work, right? They were execution mavens, right? But we're all going to now stop someday the next year or two, and we're going to evaluate.
By what is
There's
it?
still some really good portfolio companies in there, though.
By 2021, 2 years after Fixer left the fund, they'd taken up their Need for Speed for up a notch. They were investing a deal a day, including weekends.
Yeah.
Like no one can sit there and tell me that any diligence is being done or sufficient enough diligence.
Oh, look. I saw a founder who said they were in the middle of trying to get a deal done. Tiger showed up. They had a conversation for an hour. Tiger was like, "Okay, what are the terms?" They closed that deal in 10 days. They beat the terms by 20 or 30%. And what was funny to me was this founder said he had never spoken to a partner. Tiger.
So then the question that this raises, right? Because it's really easy. Okay, look. So let's also be clear. We're sitting here looking in hindsight.
Yeah.
Right. So we can see the failures of SoftBank, the failures in Tiger. I think if we were sat around this room 2 years ago, 3 years ago, we may still have had a similar like, what the heck's going on here? I'm not really sure, but like people are buying it. So maybe is there something we're missing? But at the end of the day, you ask like who it serves. Ultimately, to an extent, it serves Tiger because they get their fees, but it served those startup founders. Those startup founders, and I think we don't necessarily. I think it's really easy to fall into this trap of poor founders. You know, they get fleeced, and it's really tough to raise either. Yeah, okay, fine, I agree. There are some founders that have it tough. There are potentially systemic issues in them raising funding, etc. But if you get a term sheet from Tiger, like in a day, they've done no diligence, and it's for like multiple tens, if not hundreds of million. Most founders are going to take that, right?
And they should.
And exactly,
they absolutely should. And if they don't, they need to be flogged.
So,
okay, so that, but that's not the key issue, though.
Yeah.
The key issue, I think, is what does that infusion of money?
Yeah.
What is it? What is the negative coefficient of drag that it generates? Because it will generate that in most cases.
Well,
right?
it immediately raises the question. Like again, okay, so if you were raising right at the start of the cycle, you probably had enough room to keep raising over the next 2-3 iterations. But if you're raising at the end of the cycle and that happens, well, you're fucked. Like the next time you go out to fundraise, right? Like so, that's the drag because you could have had actually great companies built.
Yeah. But I still, it's funny. I think I wrote a tweet a couple of years ago where I was like, let me show you how Tiger can make money, even with this pace and whatever it is. And, I could sort of create some scenarios where they would actually return the money, return the fund. So the truth is, venture is such a long game that it's really hard to tell how this stuff plays out, right? But you're going to see a lot of nonsense companies shut down. And I think we're coming to that next year.
Yeah.
Right, because the money eventually runs out. Yeah. Right. Yeah. And your existing investors don't want to make any. They're just not going to support you anymore. And so I think,
or can't, because they're not raising either.
Correct. Yeah. So I think again, trying to be. We've talked about this a little bit, but the other problem with a lot of the weaponization of capital was the institutionalized loss of governance.
Yeah. At all levels.
At all levels.
Including the startup.
At all levels.
I've had VCs ping me and say, hey, we haven't seen a balance sheet in 2 years. Can you come and help out?
But you never asked for one.
Yeah.
Right? And the founder now thinks that that's how it works, and it's normal.
Yeah.
So, I think what we have to do, and conversations like this sort of help as well, is we have to sort of start to communicate to a lot of these founders the need for them to unlearn whatever it is that they learned in the last 3 or 4 years. That needs to happen. It needs to happen fast. Because the whole founder-friendly trope, I got a lot of absolute... I got insults. Because I was like, this founder-friendly thing is just complete bullshit.
And it's complete bullshit. It's gonna kill them when the chickens come home to roost, right? Like we're seeing founders... I mean, okay, we talked about it with OpenAI. Founders, you can get removed from your board, from your business.
Oh, absolutely.
And it'll happen more and more.
Oh, yeah.
Because the number of founders that can go from 0 to 1 and the number of founders that can go from 1 to 100, or the type of founder that it takes to do one or the other, are very different.
Oh, yeah. Yep. And the ones that would take from 0 to 100 are, I think there are like 14 of them.
Yeah. It's like the Zuckerbergs.
Out of 8 billion.
Yeah.
Right? So, it's just, it's crazy. I mean, we talked about how you build the next Facebook. And, it struck me because... I know a bunch of guys who did the C deal in ByteDance, and it's a $27 billion a quarter business now, and that was 2012, right? And so you're like, so it does continue, it remains possible, right, over a 10-year cycle to be able to build that kind of business. I mean, that's crazy, right? $100 billion in revenues, So we know this is possible, right? They end up being real unicorns because they're very unusual, but how do you get these founders to build? I mean, I made this point, when we talked a little bit about how, okay, maybe VCs now start exiting to private equity investors. And I was like, you've never done a deal with a private equity investor, Like they just never get super excited about it. You know, every VCs, I'm super excited, I'm thrilled.
No, but also private equity is never going to mark it up.
No, they just will not. They will not mark it up.
Yeah.
They will sit down there and tell you about EBITDA. You don't have EBITDA, so then that's another problem. But it means though that, you know, and I think to John's point, if we are going to say that private equity becomes a legitimate off ramp for our VC investments, then all the considerations have to happen at the beginning. You know, how you price the deal, how you structure and build out the business plan, how you monitor and improve performance. All of these things have to matter because, you know, these guys are not. We sold a company to a PE, right? And you know, and we also were able to sort of hold an option for the exit and whatever it is, and that's looking like it's going to turn out really well. But that's one of the kinds of deals that you have to sort of be ready.
Well, and
but they only work when to be honest, they only work, and you know, my sample data is limited, when you have founders who are very, not just capital efficient, capital sensitive.
Yeah.
At the onset.
Yeah.
Right?
Yeah.
Those are the ones that you can actually figure out how to sell to PE.
And not only that, not only the founders, but the VCs themselves, right, have to be more hands-on. They almost have to take that kind of private equity style role on the board. They have to get their hands dirty. Like every VC says they will. I mean, I know some that do. I equally know some that say they do.
Yeah.
I know some that don't at all, right? And I know a ton of founders. I wouldn't say they resent having the VC on their board, but they're like, they're not happy.
Yeah, because look, there is I have an integral member of the board that is, you know, supportive, gives me the feedback, is good when things are good, is good when things are bad. And in many cases, you have VCs that are members of, you know, they're chalk outlines.
Yeah.
Right? And nobody wants a chalk outline because that's a police investigation. That's a murder.
Yeah.
Yep.
Right? You know, so you have to ask yourself, right? And a lot of these VCs are going to sort of carry these roles on for posturing, for positioning, for PR. Meanwhile, they're actually not doing anything. And what these founders are looking for is people that can, you know, just help, right?
Yeah.
You know, and founders cannot be vulnerable, and that's another thing, right? Once you've taken the highest price term sheet and you've acted like the belle of the ball, and then everything goes awry later, it's really hard for you to be vulnerable.
Yeah.
Because people remember.
Yeah.
Yep.
Yeah. And we saw that. We saw that with Fast. We saw that with all of those businesses where, you know, these founders essentially, and it was really interesting to see the juxtaposition of people like saying this was amazing and people saying this is ridiculous, right?
Yep.
The amazing thing was that they had raised that much capital off that low revenue. The ridiculous thing was the fact that they sort of thought that was what they should have been doing, right? Like if they'd have been focused on building an amazing business, then actually the amount of capital you raise. I mean, again, like I'm an East African Indian. People argue with me about this all the time, right? I was born in Kenya. My family has business in Kenya, in sub-Saharan Africa. But, you know, they started off in 1908 with, you know, my grandfather, his brothers coming off a ship from India because of the famine, you know, sitting in trade stalls, earning a living, living with their friends or family, you know, extended family or whatever it was. Like, they did it hard. And that mentality carries through the generations where it's like one of the things one of my uncles said to me, and, you know, it's something that's stuck with me for many years, is business should be fun, but it should be profitable, right? And I think coming back, like almost tying all of this up together, one of the things that we lost sight of over the last 5-10 years, whatever it is, yeah, it was fun because it was fun to raise lots of money, but people lost sight of that it needs to be profitable side, right?
Yeah.
And the only acid test for that was when they hit the public markets. Yeah. And then people were like pulling their hair out going, oh, I don't understand. Like how is it possible they're not getting this valuation? Well, as it happens, the public markets, you know, they clear the market price based on cash flow, right? Like,
unforgiving.
Yeah.
I mean, look at some of these public companies, Bird and Co. I mean, you look at the market caps and you're like, oh, you know, I think it was Bird. I was wiping my screen because I was like, there's no way this number is right. Maybe there's a smudge somewhere or whatever.
Like 92% discount or something.
It's unbelievable.
Yeah.
Yeah.
it's a crazy time that we've been through. I think maybe as we come to, I think it's like 7:15. Maybe as we wrap things up a little bit, we wanted to talk about very briefly our thoughts on 24, 25. Eghosa, you've already given some thoughts there. Jonathan, what do you think is going to be happening over the next 12, 24 months?
Probably have a slightly little bit more optimistic view. I mean, I think
doesn't surprise me, but okay.
Yeah, I think 24 is going to be a better year than 23. I think there's going to be a lot of unknowns in the sense that, like, all right, for instance, like, OpenAI came out of absolutely nowhere, right? Nobody, if you turn the clock back into January 2023 and everyone was like, oh, AI is going to be the next great thing, and all that type of stuff, none of us would have seen that. So I think my biggest thing for 2024, 2025 is to always be ready, for like, the next sort of like, big source of innovation that comes out of nowhere.
So that is a very optimistic take. I have some thoughts there, but I'll let Eghosa go, and then I'll kind of wrap up with my thoughts.
So I've always sort of been a pragmatic optimist. All right. I mean, I'm in venture, for crying out loud, early stage venture, so I have to be. But I think the one thing that has certainly sort of come front and center this year is that it's always the folks that never fit the tailored version of what a great entrepreneur should look like who end up creating fantastic businesses. Mm-hmm. Right. And, we call them, like we've talked about this, like we like to invest in entrepreneurs that are secrets. Yeah. Right.
Yeah.
And, and why that's so important is because they're the ones that end up knowing a secret about the sector or whatever it is. And, I think one thing has sort of, re-emphasized this year is that they're the ones, they don't get any TechCrunch press. They don't, they're rarely on Twitter, right? They don't really attend conferences.
Their heads down building.
Right? They're just, they're not running sidecar VC funds, right? They're just creating material businesses. And, and I think for us, for 2024, it is to literally put fire in the engine of looking for those founders. Yeah. Because if your measurement cycle is 2028, 29, 30, they're the founders. And, maybe the first 3 years are dull. Maybe the first 4 years
dull is good. Yeah, dull isn't a bad thing, right?
Right. But at the end of the day, like what Bryce is doing, which I'm really, really happy about at Indie VC, there are going to be these types of companies. They're going to raise small amounts of money, and they're just going to just do it. But it is trying to find those founders. And, we've always said this thing about how, I still have believed it, the best founders tend to be very poor fundraisers. And the best storytellers tend to be very poor founders.
Okay. That makes me feel very sad.
Right. and so what you then look, I mean, I saw some really great deals, right? When I was at Intel, and I got to tell you, I think part of why, the Intel committees were struggling because these were not the most charismatic. Right? Oh yeah. They were just not. They were not out there trying to sell you anything, right? They're like, well, this is what I'm doing, and it's interesting, and this and that, and whatever it is. So I think, if for 2024, please, we want more of those founders. Please, it's okay to be non-charismatic. It's okay not to be a great storyteller. We'll see through that, right? We want more of those. And I think geographically, I think a lot of the emerging markets will suffer.
Yeah. Because there'll be a flight of capital. There'll be risk off again.
Look, we have one portfolio company, trying to syndicate the rest of the round, doing really well. Valuation maybe is a little bit high, but my American VC boys are just like, nah, this is it's priced too rich. Yeah. And I'm like, wow, this is an African business, and Americans are like saying the price too rich. Okay,
it's probably already like 50% discount on what's happening over there.
No problem. Yeah. We've hit the peak now. That's great.
Absolutely.
But and I think the final, and I think the final thing is that, I don't believe that it will happen. I think it should happen. I think, a lot of LPs should sit down and say, look, we need to sort of recalibrate all of these fund sizes, right? I don't think it'll happen, but I think it should.
But it's egg on face for everyone, right?
Yes,
if that happens,
it really
that's
is
a problem.
And then I think my final point is that one of the greatest disappointments, but very predictable, was that as the market went into risk-off mode, diversity took a backseat, right? Women founders, women GPs. Now, lots of people are sort of saying, "Oh, we're going to raise funds," and that sounds very opportunistic, right? But and now if you talk about DEI, diversity, equality, you're thinking, oh, everybody's like, oh, that's woke, and woke is bad, and this and that, and it's a real shame, right? And you saw this in the OpenAI thing, because when you now saw the names, I mean, I could not resist entering that conversation, because I was like, wait a minute, you have all of these names, you talk about humanity. Have you even looked at a world map recently? Right? Does this thing represent anything like the global market?
I think I can't remember if it was with you that I was talking about this, but I think it was either you and I had this conversation, someone else had the conversation. Like they should actually throttle the users in the West and actually open up, so give more access to users in, say, Southeast Asia or in Africa, so that the model can recalibrate towards that wider diversity, right? Like forgetting even the board, right? But even the product itself.
There was some guy that tweeted that some healthcare exec said they were seeing AI for X in healthcare, like 5 to 10 pitches a week. Yep. And he said the ethnic and gender bias in these products were so horrific. And I was like, predictable again.
Yeah, I mean,
predictable.
Yeah.
So bullish, pragmatically, an optimist. But I think by mid-year we are going to see the real recalibration of venture, of funds, and of startups happen. It's been delayed, but it's here now.
Yeah. So I think I would probably be on the spectrum of what Eghosa is saying. So, both working with and in startups, but also being, quite close to the VC world. I think, we're going to see pain for the next 12 months with a lot of startups, because it'll take time for all of this to wash out. And, founders are ingenious. They'll raise bridge rounds, all right? They'll raise extensions. They'll try to get to that next large round, and they'll stretch things out as far as possible. But it'll get harder and harder to do that, I think. I think and there'll be casualties that should never have been casualties, right? So sadly, there'll be businesses that raised like a year ago, 2 years ago, that are starting to run out of runway now, are going to market, are going to not be at the valuations, and therefore they're going to struggle. But actually, these could have been great businesses. Maybe they'll get recapped, maybe, right? Maybe there'll be down rounds. Maybe the founder doesn't want to take that pain. Who knows? So I think we'll see those casualties. And again, like in the conversation I had with Peter from Carter, that seems to be the trend at the moment for sure. And they're seeing more company shutdowns and liquidations across their data set in Q3. Let's see what Q4 says as well. But and it's cliche to say it, right? Tough times build great businesses. Like there will be amazing founders. I think there are founders that have cottoned on to the fact that this is where the markets are. I think the founders that still think that there is going to be a return to the exuberance and the crazy times of 3-4 years ago, they're the guys that are going to probably suffer. The guys and girls are going to suffer. I would agree on the DEI point. I think, and we'll see that with both funds as well as with startups. I think part of the problem there is you've had a lot of emerging managers from very diverse backgrounds having come out and raised funds over the last few years. Are they going to be able to raise fund 2, fund 3? Who knows? I think the final point, and I guess this is the point of optimism, right, is that, with platforms like OpenAI out there, there's never been a better opportunity to build a startup, right? The cost to build has reduced so significantly because you can use tools like that to supplement and augment your initial MVP and your go-to-market, and therefore you can be more capital efficient, right? So I think if you are someone that is able to be scrappy with the cash that you utilize, and really think about what you're building and to where you want to go, because again, like for me, I'm someone who doesn't think that a venture scale outcome is always the best answer, right? Like I think if you're a founder, I bootstrap my own business. If I exit that for 5 million, for 10 million, like it's okay. It's okay for me, right? I mean, I'm at an age where it is definitely okay for me, right? But you could take some angel funding, bootstrap to an extent, take some angel funding and exit for 20 million, right? 30 million. And that's a good outcome. And I think for most people that should be, a happy outcome. So look, to wrap up, I just wanted to say thank you so much to both of you, Eghosa and Jonathan. Really appreciate you coming out here. Eghosa, you obviously kind of spearheaded this live show, so I'm really, really grateful that you thought of us when you came to London this time. Would love to do it again, of course. Absolutely. So let's make sure we keep this in the diary. For the meantime, I want to thank you, wish everyone a happy Thanksgiving for those of you that celebrate. And we will see you very shortly on Nothing Ventured. Thank you so much for joining us.
Appreciate it.
Great.
Okay, guys, I'm gonna have to jump off screen for a second because I've got to figure out how to turn off this live show. But thank you for joining us again. Bear with us.